Good afternoon, everyone, and welcome to a rate model session for the service hospitality industry. My name is Peter Federico, and I'm the CEO for the Workers' Compensation Board, and it's my pleasure to present to you this afternoon. And I want to welcome you all and thank you for being here, and welcome to those that are also joining us online through our webinar. So what we're going to talk to you about today are the changes that will be implemented into the process by which we determine the premium rates beginning in 2018. So we're not going to talk to you today about the impacts of the changes or enhancements to the model for 2018, because we actually don't know what the 2018 experience looks like yet. So we're not going to share with you the rates for 2018. But to give you a sense of the order of magnitude, the impacts of the changes on your respective industry rate codes, we're going to show you a comparison between the 2017 premium rates as established under the current rate-making model compared to those same 2017 premium rates had they been determined under the enhanced or new rate-making model. The session is scheduled to go 2 hours, so about the first hour or so, depending on how fast I talk, I'll be presenting you with some information, and the second hour is reserved for any questions that you may have. And of course, those folks who are joining us through webinar have the opportunity to submit questions online, and we'll have those read off and do our best to answer those questions as well. I will, toward the end of the session, also show you a place where you can go after the session is over to post any questions that you have with respect to what you hear today. I'm going to try and keep this as non-technical as possible, but some of it does get a little bit technical, and we appreciate that you actually might need some soak time after we kind of flood you with some information today to formulate a better understanding of what we had to say today and submit any questions that you might actually have. So we have a bit of an agenda for this afternoon. I'm first, very high level, going to take you through the background of workers' compensation in general, how it is we came to exist and why we exist. They're going to take you through what the purpose of us reviewing the rate-making model was, and then actually show you the industry impacts as a result of the enhancements or changes to the model, and then we'll go over what the next steps are following today. So why do you pay workers' compensation premiums, or how is it that workers' compensation actually came to exist? So prior to 1915 in Canada, there was no work injury insurance program. There was no workers' compensation program. So if an injured worker, if a worker sustained an injury that was severe enough to take them out of the workplace, the only recourse that they had for compensation with respect to lost wages and or medical costs was actually to sue their employer. Most workers, of course, did not have the financial resources to pursue a lawsuit, and in the majority of times, even when they did, they were not successful in actually winning the lawsuit or proving negligence on the part of the employer. On the other hand, when they were successful, it most times meant the demise of the employer, pushing the employer into bankruptcy. Neither situation being particularly favorable from an economic perspective. In Canada, the Ontario government was the first to notice the impacts of not having a workplace injury insurance program. And where they noticed that were in their social security systems. So in the absence of a work injury insurance plan, workers who had no income, who could not afford to pay for the medical costs, made their way into the social assistance or social security programs of the day. And the government noticed a substantial increase in the number of individuals that were going on to social security or social assistance because they had no other means to support themselves or their families. So in response to that, in 1913, the Ontario government appointed a fellow by the name of William Meredith and asked him to study the situation and come up with a recommendation, some alternatives in terms of what we might do with these individuals who were injured at work and yet had no other means of compensation other than social assistance. And so Meredith went to work and developed the first compensation system in Canada based on something he called the historic compromise. And what Meredith did was brokered a deal between workers and employers, whereby workers agreed to give up their right to sue the employer in the event of a workplace injury, and employers in turn agreed that they would fund a workers' compensation insurance, injury insurance program. This historic compromise became legislation in Ontario in 1915. The foundational pieces of that piece of legislation spread across the country. In 1930, Saskatchewan introduced its first workers' compensation legislation and formed its workers' compensation board. Again, based on the same principles that Meredith envisioned when he studied the circumstances in Ontario. The fundamental principles of workers' compensation, again, as Meredith envisioned, not only are the foundational pieces of compensation programs in Canada, but actually support compensation systems around the world. Meredith had 5 principles that he thought were of paramount importance in terms of setting up a compensation system. I'm not going to go through all of them. I'm going to touch on a couple of key ones that I think relate directly to what we're going to be talking about later. But if you are interested in knowing more about all of the principles that Meredith had talked about, you could go online. We did some regional educational sessions in November and December, and those are actually available online at wcbsas.com. There is a video and audio version of our presentation, and you can follow through that where we go into more detail about the history and some of the elements of the new rate-making model that I'm going to share with you today. But 2 of really important principles that Meredith envisioned was, first of all, the system had to be no fault. So the worker did not have to prove negligence on the part of the employer, nor would the worker be held responsible for any aspect of actually having the injury. Did not have to prove how the injury actually occurred, other than that it did occur at work, but not whose fault it was. The second important principle was something called collective liability. And collective liability really is a foundational piece for all insurance programs, not just workers' compensation. All collective liability refers to, at the highest level, is that the insured, the policy holders, together are collectively responsible for all of the costs or all of the liability associated with the claims in the insurance program. So if you think about this in terms of our own private insurance, our home insurance or car insurance by way of example, we together with all other homeowners share in the costs of any house claims that might be made, and we pay a premium in order to fund whatever that liability might be as determined by the insurance company. That same concept of collective liability applies to workers' compensation. So we have all of the employers in workers' compensation who are required to have workers' compensation coverage contributing to and accepting collective liability or responsibility for the entire costs of the whole compensation system. So that historic compromise and the 5 Meredith principles, as I said, continue to be the foundational pieces of compensation programs in Canada and have truly stood the test of time. So how do we actually go about establishing the premium rates that we're going to charge you? It's a 3-step process that begins with what we call industry classification. So in Saskatchewan, there are approximately 47,000 employers that are covered by workers' compensation. What we do is we take those 47,000 employers and we divide them up into what we call industry rate codes, but are really risk pools based on their primary business activity. And I'm going to talk about S21 in a minute. It's a bit of an anomaly, but generally speaking, we look at the primary business activity and we group employers who share that primary business activity into these industry-based rate codes. And this concept of collective liability now gets narrowed a little bit such that employers who belong to a specific industry code share in the collective liability of all of the claims that happen to any of the employers in that particular risk pool or industry rate code in workers' compensation terms. So again, if we think about this in terms of our own home insurance, we are actually placed in insurance risk pools based on the type, size, construction, location of our homes. So if we have wood frame construction as opposed to brick, if we have wood burning as opposed to gas burning fireplaces, if we live in a floodplain or in Tornado Alley, we're going to be grouped with homeowners in a similar circumstance who share the same kind of risks. And collectively, we're responsible for the costs associated with all of the claims that occur in that particular risk pool. That same concept applies to workers' compensation. We simply call it industry classification and the creation of 50 rate codes. So we take these 47,000 employers, we put them in 50 individual rate codes based on their primary business activity or risk associated with the activities in their primary business. So that's the starting point of the rate setting process. Then what we do is we go through a rate setting process, which is step 2, that I will get into greater detail when I address the various enhancements to the rate making model. But it's the process by which we determine what the future costs of claims will be on a rate code by rate code basis and establish the premium rate necessary in order to fund those costs. So when we set the 2017 premium rate, we were actually doing that. We started that process in 2016. So in August, September, what we were doing was we were looking at historical information and using that historical pattern of injury experience to help us predict what type of injury experience we would see in 2017 for each of those 50 rate codes, and determine the costs associated with the injury experience in those 50 rate codes, and determine the premium rate necessary to collect sufficient funds to pay for all of the current and future costs of claims that would occur in each of those 50 rate codes. That kind of concludes step 2 of the process and determines what we call the industry-based premium rate. So every employer in S21, by way of example, starts off by paying exactly the same premium rate, which is based on the collective experience, all of the claims experience of all of the employers in S21. But recognizing that individual employer injury experience will be different, we seek to apply something called experience rating to that base industry premium rate to determine the final rate that each individual employer will have to pay us in order to insure themselves for the coming year. So the 2017 premium we're going to collect is intended to pay for all the costs associated with injuries that occur in 2017 based on our predictive model of what injuries and what cost of injuries will be for 2017. And then we look at individual employer experience within that rate code, and we apply what we call experience rating to it. So again, if you think about this from your own private insurance perspective, if you have a lot of house claims, your premium is going to go up compared to everybody else. You're going to get charged a kind of a surcharge, if you will, because of utilization of the program. However, if you have few claims, you're likely to receive a discount. This is very noticeable on our drivers and our vehicle insurance. If we don't have a lot of incidents, we actually get a rebate back from SGI. If we have a lot of incidents, we actually see a surcharge that's applied. We actually pay a premium over and above the regular premium. Experience rating program does exactly the same thing. It's divided into two streams. First is what we call the standard program. The standard program is designed for small employers who pay us less than $21,000 cumulatively in premium over the most recent 3 years. That program is based on frequency, so the number of claims that you have. And depending on the number of claims that you have, would either entitle you to a discount, the maximum of which is 25%, or a surcharge, the maximum of which is 75%. The other program is called the advanced program, and that's intended for large employers who pay us at least $21,000 in premium over the last 3 years. That program is cost-based, not frequency-based. So it's not the number of claims, but the cost of the claims. If the individual employer cost experience is worse than the average for their rate code or industry group, they could pay us a surcharge of up to 30%. If it's better than the average for their industry group, they could receive a discount of up to 200%. That will determine then, after step 3, that's actually going to be the rate that you would see on your invoice from us for insurance coverage for the coming year. What we're going to talk about here this afternoon in terms of enhancements and changes to the rate-making model in no way will change that experience rating program. So it will remain as it is. What we're talking about here is simply getting to the end of step 2 in a different manner than what we have traditionally done. And then applying the same experience rating program to the individual employer experience. So why would we have even bothered to look at this? So the review of the rate model was actually part of what I call a review of our entire financial system. The Workers' Compensation Board is 100% funded by employer premiums and returns that are earned on our investment portfolio. So there's no funding from government. We do not pay government any money. We are a quasi-independent agency that has to survive on the premiums and returns on our investments. We currently have about $1.8 billion in investments under management. So where do those investments come from? So as I indicated earlier, when we set out to charge you a premium, we're charging you a premium for all of the injuries that will occur in that premium year well into the future. Some of our injury claims can last up to 50 years. So we will pay costs from 2017, if that's our premium year, 50 years out potentially. Why would it be 50 years? We have workers now at the age of 15 who sustain an injury. Some of those can be very seriously and permanently impair their earning capacity. Their entitlement to wage loss payments under our compensation system ends at age 65. So there's 50 years of potential entitlement of benefits. So even though we pay out all of these costs over several years from the year of the premium collection, we collect all of that premium up front so that the employers of today pay for the cost of the injuries that occur today. And those costs are not passed on to the next generation of employers. Because we don't spend all that money in 1 year, we take those premiums and we put them into an investment portfolio. And that investment portfolio exposes us to various asset classes. equities, bonds, real estate, mortgages. That's all part of our financial system. It's an integrated part of what keeps the workers' compensation system going and supports the premiums that we collect in order to pay the future costs. So we need to earn a minimum rate of return of 5.25% our investment portfolio in order to be able to fund the future costs of claims for the premium that we collect today. So it's kind of, if you think about it like we were planning for your retirement and you determine you need X number of dollars on the date of your retirement. You're going to save so much per year based on an anticipated rate of return. So you're going to put principal away. You're assuming that principal is going to earn a certain amount of money. So in 20 years from now, that money is going to grow into a certain amount that you'll have at the end. This is very similar to that. We know what the total cost, or we estimate what the total cost of claims will be. We then calculate how much do we need to invest today at a certain rate of return in order to make those future obligation payments. So the first step in our financial system review was to look at how we structured our investments. Are we properly allocating those investments among the various asset classes available in order to maximize our return but minimize the volatility in the returns? So we weren't looking for drastic, like 20% returns and then 20% negative returns. We were looking for stable returns that returned a minimum of 5.25%. So we made several changes in terms of, well, we invested in Canadian versus US versus global equities versus bonds versus real estate versus small cap equities and so on and so forth. We then hired an actuary by the name of Eckler to come in and conduct something called an asset liability study. And the asset liability study was to affirm that what we had done in terms of changing the asset mix in our investment policy would actually match the necessary cash flow requirements on the future claims payments. So were the likely inflows from our portfolio going to match the outflows required in order to make the claim payments? So that was the starting point. How well have we matched the assets with the liabilities? So Eckler came in and had a look at it and said, yes, in fact, the strategy that you have will maximize returns and minimize volatility and ensure the ability to pay future costs. But in the process of doing that, because the other integral part of our revenue stream are premiums, he said it's probably time that you actually had a review of your rate-making model, the process by which you actually determine how much you have to collect and invest. We were also hearing from employers at the same time who said the existing model that you have is simply not reactive enough to the most current experience. The model takes way too long to respond to changes or deteriorations in the actual injury experience in the industries. And so for that reason, we undertook this rate model review. And in so doing, we were attempting to balance what are often seen as four competing principles. The first being the principle of collective liability, which I talked about. And that's the extent to which employers jointly, collectively share in the liabilities and costs associated with injury claims. There's also an associated principle within collective liability that says employers should not be unduly burdened by excessively costly injury claims. So our challenge in approaching the rate model review was balancing accountability at the rate code level, wanting industry to be accountable for the costs of its injuries, but at the same time providing for collective liability. As the scales would indicate, if we increase the collective liability, we decrease the accountability. And if we increase the accountability, we decrease the collective liability. We are looking for ways to balance those two things. Also recognizing the importance for employers to know that their rates are somewhat stable, that they're not going to see large swings in their premium rates. We knew it was important to balance rate stability with the need to have a reactive model. If we make the model too reactive to current experience, so we use simply the last year of experience to forecast the next year's experience, we're going to create extreme volatility in the premium rates. The premium rates will swing all over the place. So balancing the need to have stable rates with the need to have a model that's reactive to recent injury experience became increasingly important, together with the balance of the collective liability and accountability at the industry level, within a model that was as transparent as possible. So ultimately, what we're trying to do in establishing the premium rates is predict the future costs of claims. Because the premium rate is based on the future costs of claims. That's what we're trying to fund. So predictability of costs becomes increasingly important as we look at modifications or enhancements to the rate-making model. Secondly, we needed to maintain fairness and equity among all employers. And lastly, the model need to be based on actuarial standards, which means making it as scientific as possible, excuse me, and removing the need for any interventions in order to maintain the balance between collective liability and accountability and reactivity and rate stability. So what were the findings of the Eckler review? Generally speaking, Eckler said the rate model works well in terms of predicting premiums required to fund future claims costs at the board level. So you're going to hear me refer to board level or board level experience probably throughout this presentation. When I say that, what I'm meaning is the collective experience of all employers, all 50 rate codes. So if you think about it this way, we announced our 2017 average premium rate of $1.24. If we only had one rate code, so we just threw all employers into one pot, did not seek to divide them up into industry rate codes, everybody would pay $1.24. What Eckler determined is that $1.24 is adequate, is sufficient, is the right number to fund the future costs of the claims that would occur through all 50 rate codes. But he also noted that when you got down into the individual 50 rate codes, it did not do as good a job in terms of setting premium rates that reflected the fairness and equity, accountability, reactivity of the injury experience in each of those 50 industry codes. So he said, we don't need a total overhaul here, but we certainly need some enhancements or refinements to the system. So when we ran the new model, which I'm going to share with the elements of in just a minute or two here, when we ran the new model at the board level for all 50 rate codes, and we compared that to the average rate of $1.24 calculated under the current model, it came out exactly at $1.24. So this is not about collecting additional total premium. This is about ensuring that fairness and equity and accountability at the individual rate code level and the predictability of costs at that rate code level are enhanced and improved. Eckler made 7 recommendations, and I'm going to go through each of those except for one that I want to cover off right now, and it's the second one, this whole issue of classification. I already talked to you about classification. We divide things up into 50 individual rate codes. What Eckler noted and what we have noted for several years is some of those industry rate codes are extremely small. We have some rate codes that have fewer than 20 employers in them. When we look what our models do, and that's preserved in the new model, what our rate model does, it actually looks at historical spending patterns to help us predict future patterns. And in the current model, we look at the most recent 5 years. So we calculate a 5-year average, and we use that 5-year average to help us predict what next year's claims costs are going to be. if you have an industry code that has less than 20 employers, the amount of claim costs flowing through that industry rate code is likely very small. And so, because it's not a very big sample size, it can create extreme volatility. It's not very reliable. You don't have enough of a sample size to be reliable enough to use that to predict what the future claims costs are going to be. So Eckler suggested that from a classification perspective that we ought to develop a process whereby we periodically and systematically review the classifications with the thought of perhaps merging some of these small rate codes, bringing them together. The board agreed that we ought to have a process by which we periodically and systematically review the classifications, and have asked us to build such a process, which we will undertake in the next several months here. But in the meantime, there are no immediate plans for us to merge any of the rate codes. So until such time as we build the process, and building that process will require deep analysis and, of course, consultation with employers that might be impacted by any potential mergers of the rate codes as they exist today. So we're probably looking several years out before we actually complete the entire review of the classification system. However, we will build that process. We hope to have that process built perhaps as soon as the end of the year. So looking at the other recommendations that really have substantive impacts on premium rates in the individual rate codes. Again, just a reminder before I get into the details, what we're talking about here is simply a comparison between the 2017 premium rates as calculated under the current model and what the 2017 premium rates would have been had we implemented the new model in 2017. Why wouldn't we have implemented the model in 2017? Because, as you'll see, the impacts of some of the changes on individual industry codes can be fairly significant. We didn't think it prudent or reasonable for us to proceed with implementation without firstly providing background and education around why the changes were made and giving you a glimpse into what the potential impact would be of us implementing this premium rate in 2018. Your 2018 premium rates will not be ready until sometime this fall, where we will update it for 2018 experience. But just to give you, again, an indication of the order of magnitude of what we're talking about in terms of adjustments, we wanted to show you the comparison between old 2017 rates and new 2017 rates. First recommendation that Eckler talked about is this notion of credibility. And credibility really refers to the reliability of using historic spending patterns to predict future spending patterns. And it is very closely tied to the classification issue I was just talking to you about. So what Eckler noted is you have very many, very small industry rate codes. And under the current model, regardless of the size of the rate code, we calculate a 5-year average. And we use that 5-year average to predict what the future costs are going to be. However, for those very small rate codes that are not credible, in other words, their 5-year experience is not reliable in predicting future experience, we intervened by applying the board level experience, the average experience for all 50 rate codes, to that individual industry experience to smooth or mitigate the experience in that industry class, make it more credible, and reduce the volatility that low experience in a small rate code might bring into the predictive model. The second thing we did to try and deal with non-credible, non-reliable rate codes, if you will, is we introduced something called premium blending. So what we did is we let the 2017 model run just as it is without intervening. It pumped out a 2017 premium rate. But in order to mitigate the volatility of premium rates and the unreliability of the predictions, we would average that with the 2016 premium rate to come up with your net 2017 premium rate. And when we talk about predictability of costs, I'm going to dive into that a little bit deeper. But you'll see that as years have evolved and business and industries have changed, we have intervened in different ways in order to preserve the principles of rate stability and reactivity and accountability and collective liability to remove the volatility and improve the predictability. Eckler said, it's too much intervention. That's not a reliable way to do that, and you should stop doing those kinds of things. What he did say, though, is where you have industry codes that are not credible, that are too small to have a large enough sample size in 5 years to help you predict future years, what you should do is expand that window to 10 years. So look at historic 10-year patterns compared to the 5-year average. And use that blend of a 10-year average and 5-year average as a more reliable predictor of the future. But stop this smoothing or application of board-level experience to mitigate the experience at the industry level. So what that really does is increases the accountability at the industry level by making it stand on its own experience, but mitigating the volatility experience by extending the historic review period from 5 to 10 years. Eckler defines a 100% credible industry as an industry that has at least $16.5 million in claims costs passing through that rate code over the last 5 years. So if an industry rate code has $16.5 million in claim costs, it's considered to be 100% credible, which means we will use the 5-year average to forecast future costs. It's reliable. If an industry code only has $10 million of claims costs going through it over the last 5 years, it only has 60% credibility, which means the 5-year average is only reliable 60% of the time in predicting the future. The 10-year, though, adds the additional 40%. So what we would do in the case of my example is we would use 60% of the average of the last 5 years and 40% of the average of the last 10 years as a blended average to predict what the future costs would be. Now, what are the implications on the individual industry codes as a result of that enhancement? Generally speaking, if the industry's injury experience was worse than the average of all 50 rate codes, what I call the board level experience, by removing the intervention of the board level experience on the industry experience, you would see the premium rate go up. If the industry experience is better than the average, so not as many costs and claims as what you see at the average of the 50, by removing the influence of the board level experience, you would actually decrease the premium rate. However, depending on the credibility of the industry, because we've expanded the window now to take in 10 years instead of just 5 years of claims cost experience, if you have significant claim costs, you're a non-credible industry, and you have significant claim costs in the 10-year experience, you're likely to see your premium rate go up. And conversely, if your 10-year experience is low, you're likely to see the premium stay the same or go down. So what does S21 look like? So S21 is, we call it community and social services. But this includes, it's really a mishmash of businesses, if you will, who are grouped together because they're not large enough individually to stand on their own, but that would have similar risks in terms of their underlying business activity. So it's things like hostels, like aid societies, it includes sheltered workshops, It includes, did I say daycares? It includes preschools. It includes vet clinics, funeral homes. Like, it's quite a non-homogeneous group in terms of business activities that have been put together as a result of similar risks. The implications of removing the influence of the work overall board level injury experience and changing the blending period has the net effect of increasing, would have had the effect of increasing the premium rate for S21 by a penny. The reason for that is as follows. So the injury experience for S21 was very similar to the board level. So there was no influence by us removing the board level experience on the industry experience. Similarly, it's 100% credible. So S21, that means S21 had at least $16.5 million in claim costs going through it over the last 5 years. But there's one other element that changed, not as it relates to credibility, but as it relates to the model as a whole. Under the current model, generally speaking, and I told you this, we use a 5-year average for all industries to predict the future costs, except for healthcare costs and vocational rehabilitation costs. Because those costs have tended to grow more quickly in recent years than the wage loss costs in the compensation system, we've been using only a 3-year average. Eckler said you should not differentiate between cost types and simply apply a 5-year average to all. As a result of us not using a 3-year average for healthcare costs anymore, but expanding it to 5 years average for healthcare costs, actually had the effect of adding a penny to S21's premium rate, which means that the healthcare spending on average was greater over the 5-year period than it was over the most recent 3-year period. So as a result of those changes, you would have seen a 1 penny increase in S21. S22, which is restaurants and includes dry cleaning, would not have been impacted by this at all. Their experience was very similar to the board experience. They're 91% credible. The net effect of both of those changes would have had zero impact on S22. S23, which are the hotels, motels, includes the taxis, would have actually seen a 1 cent decrease in their premium rate. Their injury experience is better than the overall board experience. So when we applied the board experience, it actually raised their injury experience. So that would have the effect of dropping their premium rate. However, they're only 84% credible, which means we would have been picking up 16% of their 10-year experience, which wouldn't have happened before. That would have had the effect of increasing their premium rate. The net effect, however, would have been a 1 cent reduction in their premium rate for 2017. The next recommendation that Eckler had to do with the use of indicators to predict costs. So I already told you we look at historic spending patterns, historic costs in order to predict future costs. But the existing model relies heavily on forecasting time loss claims. So as time loss claims dropped, we assumed that the costs associated with those claims would also drop. And so our process of estimating the number of claims we're going to have and applying an average cost per claim, in Eckler's view, was not accurate or reliable in terms of forecasting future costs. While we've seen significant decreases in recent years in the number of time loss claims, we have not seen a corresponding decrease in the cost of time loss claims. As a matter of fact, they're going in opposite direction. Claims costs are actually increasing while the number of claims is decreasing. So when we plot the change in time loss claims against the change in costs, there is actually a negative correlation between the two. There is no relationship any longer. There used to be, But with the rapid decline in number of claims and other factors impacting the costs of those claims, there is no longer a relationship between the number of claims and the actual total costs of claims. Eckler said you should not rely on time loss claims at all. Instead, what you should focus on are the actual claims costs themselves. So stick to the calculation of your 5 or 10-year blended average, but adjust that for inflation, if you will, to index that by the expected change in the workforce. And the change in the workforce simply means the change in the number of workers that are insured in that particular industry. When we plotted change in workforce against change in costs, there was almost a 100% correlation between the two. The lines were almost right on top of each other, which in fact validated what Eckler was telling us, that there is a strong correlation between the change in the workforce and the pattern of injury claim costs. So Eckler said, stick to the calculation of your average, but if you see the workforce growing by 5% moving forward, adjust those claims costs by that 5% anticipated growth in the workforce. So what are the implications to industry? Generally speaking, if time loss claims were dropping in the particular industry, what that would have had the effect of doing in the existing model is assuming that claims costs are also going to drop. So it would have held the premium artificially low. By not relying on time loss counts anymore and looking strictly at the adjustment of the change in the workforce would generally result in an increase in the premium rates. The other factor that comes into play here, however, is that notion that I introduced when we were talking about credibility, and that's the blending of the premium rates. So we would have calculated the 2017 premium rates, but because we didn't trust, we saw the divergence of the trend in time loss counts with claim costs. We actually averaged the 2017 premium rate with the 2016 premium rate. So if your 2016 premium rate was higher than your 2017 premium rate, by removing the blending would drop your premium rate because we're no longer artificially bringing up your premium rate using the average of the 16 and 17. So what are the impacts on the individual industry codes as a result of those two changes? So when we look at S21, we'd actually see a net 3 cent increase in the premium rates. As a result, so this particular industry code, generally speaking, saw decreases in their time loss claims, which would have been drawing down their claims costs. Removing that and introducing the adoption of the change in the workforce would have added 9 cents to their premium rate. However, removing the effect of the blending of the averaging of premium rates would have actually reduced the premium rate by 6 cents. The net result being a 3 cent increase in the premium rate. S22, similar story, but a penny increase. The adoption of the workforce and removal of the influence of the time loss counts would have added 5 cents, but the removal of the blending would have reduced the rate by 4 cents, leaving a 1 cent increase in the premium rate had we implemented this January 1st of 17. S23, a similar story, but far more dramatic. S23 saw significant decreases in the number of their claim counts, which would have artificially lowered the anticipated costs of those claims. By removing the influence of time loss counts and introducing the adoption of the workforce, would have actually seen an 18 cent increase in the premium rate. By removing the blending, the averaging of the 16 and 17 premium rates would have resulted in a 10-cent decrease. The net result being an 8-cent increase had we implemented this January 1st, 2017. Now, you can see we still have a few elements to go through here, so we shouldn't come to any conclusions on what this is going to look like until we actually get to the end. So we shouldn't get too happy or too excited until we actually see how the entire picture unfolds and what the ultimate impact on industry would be when we implement all of these pieces. So this is not a pick and choose thing. All of these changes have to be implemented together in order to improve the integrity and reliability of the rate model. The next recommendation that Eckler had to do with claim cost pooling. Claim cost pooling simply refers to, again, it relates to the collective liability concept, but it also introduces the concept of a costly claims cost cap. Remember, the collective liability I said had two elements. First being employers collectively share in the liability of all claims that occur in their industry. But the second was that employers should not be unduly burdened by any excessively costly injury claims. In the existing model, there is a claims cap. It's $90,000, but it's applied only to long-term earnings replacement, or what we often refer to as pension claims. So an earnings replacement or pension claim is a claim that has some permanent loss of earning capacity and is going to receive benefits likely until the age 65. So we put them on a monthly pension, if you will, but it's long-term earnings replacement. So under the current model, if the cumulative costs of a claim as it relates to the earnings replacement costs exceeds $90,000, we cap the cost of that claim to the industry code. And we take the difference between the actual cost of that claim and $90,000, and we spread it proportionately based on payroll among all of the S rate codes. There are 9 S rate codes. We're only looking at 3 today, but there are 6 other S codes that belong to the S class. So any pension claim in any one of those 9 S codes whose cost exceeds $90,000 today is capped at $90,000, and each of the S rate codes, based on their payroll, picks up a proportionate share of the excess. So if we have a pension claim whose costs are $150,000, the industry code would take on responsibility for the first 90. The other 60,000 would be spread proportionately, not evenly, proportionally based on payroll across all 9 S rate codes. Eckler said, claim cost pooling and capping is an essential part of a rate-making model. However, the way you're doing it has a couple of problems. First of all, the $90,000 is a fixed amount and has been around for a number of years. It actually needs to be indexed so that it moves with the changes in the cost of claims. So he recommended that that maximum claims cost should be a factor of something that provides for an indexing provision to that maximum costly claims cap. And what he recommended was a multiple of the maximum insurable wage. After analysis, we determined that 3 times the maximum insurable wage is the appropriate costly claim cap, which today amounts to roughly $252,000. So under the enhancement, and that has been approved by the board and is included in the revisions to the rate model, with that enhancement, any claims costs that would exceed $252,000 would be capped at $252,000. And the difference between the total cost of the claim and the cap of 252 would be spread among all 50 rate codes, not just the 9 in the S class. The second thing that Eckler noted, though, was that this cap should not just apply to earnings replacement claims, it should apply to all claims costs. So in my example of the $150,000 pension claim, under the enhanced model, the industry would bear 100% of the cost of $150,000. Be no capping any longer. They would have to absorb all of that cost and be accountable for that cost. However, if you had a claim, any claim, that exceeded $252,000, the industry would be responsible for the first $252,000, and the difference, the excess, let's say it's a $400,000 claim, $148,000 would be spread across all 50 rate codes based on their claims costs, not their payroll. So what are the implications of those changes to the individual industry classes? Well, if an industry class benefited, if it had pension costs in excess of the $90,000, it would have benefited from the pooling, from having that spread among all of the S class. By removing that, would actually increase the accountability of the rate code and increase the premium rate. But if the costs exceeded $252,000, there would still be pooling, now on the basis of claims experience, for all costs. So while you might see your premium rate increase as a result of removal of the cap on the pension costs and replacing it with this all claims cap at a higher amount, you might actually benefit from another claim that isn't a pension that has costs in excess of $252,000. Conversely, if an industry code did not have any pension costs in excess of 90 and was having its premium rate bumped up as a result of the pooling of pension costs, you would see the premium rate go down. But again, conversely, you're going to pick up a share now of all pooled claims costs in excess of $252,000, which might have the effect of increasing your premium rate. So again, we have two factors working, in some cases in opposing ways in terms of their impact on the premium rate as a result of us making the changes to the claimed cost pooling. So for S21, the net impact, the pooling actually used to increase the premium rate. So S21, essentially what this tells me is S21 was subsidizing the other premium, or the other rate codes, I should say. And so by removing that pension cap and the spreading at the S code, it had the impact of actually dropping their rate. However, they were one of the ones who were picking up a portion, though, of the costs in excess of $252,000, which would have the effect of increasing their premium rate. The net effect, however, would have been a 1 cent drop had we implemented this January 1st of 2017. S22, a different story. S22 used to benefit from the pension pooling. By removing that pension cap and making S22 more accountable for their pension costs, would have had the impact of actually increasing the premium rate. They too would be picking up a portion of the costs of all claims in excess of $252,000, and that would have added to their premium rate as well. The combined effect would have been a 3 cent increase in the S22 premium rate for 2017 had we implemented this January 1. S23, a similar story. They used to benefit from the pension pooling, so they had pension costs in excess of $90,000 that other S codes would have been sharing in the costs of. And they're also going to pick up a portion of the pooling of all claims costs in excess of $252,000 the combined impact being an increase in their premium rate of 5 cents. The next recommendation Eckler had to do with the allocation of fatality costs. Under the current model, every rate code shares identically in the average costs of fatal claims. So under the current model, we calculate a 10-year average for all fatalities across all 50 rate codes, and every rate code pays that proportionate share of the fatality costs. So in 2017, every one of those 50 rate codes has 4 cents included in its premium rate, whether they had a fatality or not. Eckler said that's not doing much in terms of holding industry accountable, and recommended that industry that has the fatality should be held accountable for the costs of the fatality. So that recommendation was taken to our board, and the board asked us a very good question. They asked, but how is a fatal claim any different than any other claim? And other than the obvious, when you look at it strictly from a cost perspective, there is no difference. And so what the board said is, yes, industry that has fatality should be held accountable for the fatality, but not unlike any other claim. Which means that the 252 claims cap would apply to fatalities as well. Cost of fatalities can vary from a single individual with no dependents, the costs of which might only be burial costs of $10,000, to an individual married, 3 dependents, could run up costs as high as $1.6 million. So in order to maintain this concept of collective liability and treat these fatal claims like any other claim, the $252,000 cap would apply to fatal claims in excess of the 252, and the remainder of the cost will be spread among all industry codes on the basis of their claims experience. So what's the impact on industry? Well, generally speaking, by holding industry accountable for its own fatalities, if the actual average cost of the fatalities is greater than the 4 cents that is currently in the premium rate, you would see the premium rate have gone up. If it's less than that, you would actually have seen the premium rate go down. So S21, in the last 5 years, the most recent 5 years, 2011 to 2015, had one fatality. It's 100% credible, which means we only look at the last 5 years claim experience. The cost of that particular fatality was obviously 5 cents less than the 4 cents being currently charged, and so the effect of this impact would have been a drop in the premium rate of a penny. S22, similar outcome. This particular rate code, again, this is the restaurants, catering, and dry cleaning, actually had 3 fatalities between 2011 and 2015. They are 91% credible, so we apply 91% credibility to their 5-year experience and 9% to their 10-year. The average cost of their claims was obviously less than the 4 cents by a net 3 cents, and so the premium rate, in fact, would have decreased by 3 cents had we implemented this January 1. Similar story in S23, however, a smaller impact. They have 1 fatality in that 5-year period. However, they're only 84% credible, which means we'd only be picking up 84% of their 5-year experience and picking up 16% of their 10-year experience. So they must have had fatal claims in the other 5 years to make up their entire 10-year. That would have mitigated the decrease in the premium rate to a penny. So instead of paying 4 cents, they would only have been paying 1 cent on the fatalities. Next recommendation has to do with long-term claims. So I indicated earlier, again, I'm repeating myself, that we use a 5-year average in order to predict future costs. Under the new model, we use a 5-year, or depending on the credibility of the industry, a 5-10-year blend. Under the current model, however, we take all costs in that 5-year period. And here's what I mean by that. Again, I said earlier that we could have claims that last up to 50 years. So in setting the 2017 premium rate, we would have used the injury years of 2011 to 2015. In 2011, there's a strong likelihood that we would have had costs paid in 2011 that actually relate to a claim that happened 20 or 30 years ago, because there'd be ongoing costs. Similar for 2012. It's quite likely that we would have old claims costs being paid in 2012. Under the current model, we didn't care when the injury happened. If the costs landed in one of the years included in the average, we included it in the calculation of the average. Eckler said he didn't think that was a very, very good approach to take, because what we were effectively doing was assuming that injuries that happened 30 years ago are going to repeat themselves 30 years from now, which isn't necessarily the case, because industry has changed, the way we do business has changed, the technology has changed, the circumstances of the way business functions today be significantly different than the environments 30 years ago. In addition, he said, it really limits the reactivity of the model if you're dragging current experience down by very, very old experience. So Eckler recommended that we shorten the number of years we would look at historic costs in each of the averaging years to something less than current, and recommended between 5 and 10 years. When we did our analysis, we landed somewhere in the middle and determined that at 7 years, we would actually capture 75% of the costs. The board has agreed with that. So under the enhanced model, we will no longer be including costs in any one of the years included in the calculation of the average of claims that are older than 7 years. So for 2011, we would only include in the 5-year average claims that occurred in 2015 or earlier. For 2012, only claims that occurred in 2006 or later, and so on and so forth. So we're only taking up 7 years of experience now in determining either the 5 or the blended 10 5-year average. There are still costs associated with those other 43 years, so what do we do with those costs? Because our premium rate has to cover all of those. Eckler suggested again that those costs are pooled and spread at the board level based on claims experience among all 50 industry rate codes. Generally speaking, if the majority of experience of an industry rate code is in the most recent 7 years, then by removing the other 43 years from the average would actually have the effect of increasing the average and increasing the premium rate. If a larger proportion of costs are in the claims that are more than 7 years old, removing that would have the effect of dropping the average and dropping the premium rate. So what are the circumstances in the S codes we're looking at today? So S21 had a larger proportion of claims in the 7-year window than it did in the 43-year window. So by taking the 43 window out of the averaging, the average cost of claims increased, which would have added 5 cents to the premium rate had we implemented this in 2017. S22, a similar story, but not quite as dramatic, would have added, again, the majority of costs being in the most recent 7 years, would have increased their average, increased their premium rate by a penny. S23, very, very similar story. Majority of costs in the most recent 7 years, but had the impact of increasing their premium rate by a penny. The last recommendation had to do with the allocation of administration costs. So the Workers' Compensation Board is not unlike any other businesses. When we look at our administration costs, they fall into one of two categories: fixed or variable costs. Fixed costs from a workers' comp perspective are costs that do not relate to the management or adjudication of a claim. They don't have anything to do with claims. So this would include all our employer services costs, so our registration process, the actual rate setting process itself, our clearance processes. It would include all our infrastructure like IT and human resources and those kinds of things. Under the current model, we determined that 10% of our administrative costs were fixed, and those are allocated among all industry groups on the basis of their payroll. The variable costs, accordingly, which are costs directly related to the adjudication or management of claims, we determined to be 90%. And those costs were distributed among all industry groups on the basis of their claims experience. Eckler said this is a good approach, a good strategy. However, Eckler has experience with other workers' compensation boards in Canada, has done work for various of the other boards. What he said is you might want to do some analysis here because your 90-10 split looks a little bit offside with what I'm seeing at other workers' compensation boards. So we actually undertook an analysis. What we determined in actually categorizing our administration costs into the fixed and variable as I described it, is that a more accurate allocation is 30% fixed and 70% variable. And so what the board has approved is an increase in the fixed element of our administrative costs from 10 to 30%, which means that our variable component drops from 90% of our administrative costs to 70%. We will continue to allocate our fixed costs on the basis of payroll among all industry codes and allocate the variable costs on the basis of claims experience among all industry codes. Generally speaking, if an industry has high payroll relative to its claims costs, because of the increase in the fixed component, it was going to see an increase in their premium rate. If it has claims costs proportionally higher than payroll, it might see no change or an increase in their variable rate or offset by an increase in their fixed rate. So let's have a look at the individual rate codes and see the impact. So for S21, the variable component for S21 would actually go down by a penny. However, the fixed component would increase by 6 cents. Sorry, would decrease by 2 cents. I should put my glasses on. The variable component would decrease by 2 cents. The fixed component would increase by 6 cents for a net increase of 4 cents. S22, a net increase of 3 cents, a similar increase of 7 cents in the fixed component, and a decrease of 3 cents in the variable component for a net increase of 4 cents. An S23, similar, relatively smaller increase, would see a decrease on the variable side. Didn't change. Similar decrease on the variable side of 6 cents, an increase on the fixed side of 7 cents for a net increase of 1 cent. So when we look at all of the increases and decreases that would have impacted premium rates had we implemented this in 2007, we now get an overall picture of a proxy for the overall impact of the implementation of the new rate-making model. So in total, what does this really mean? So for S21, which is that kind of non-homogeneous grouping of several different kinds of businesses, the net result would have been an 11-cent increase in the premium rate. Now, what does this actually mean in real terms? What it would have meant is that in total, S21 would pay us an additional $689,000 roughly in total premium. There are 1,258 employers in this particular rate code, which means on average, it would have meant an increase in employer premiums of $548. For S22, we would see a total increase of 5 cents in the premium rate, which translates into an increase in total premium of roughly $347,000, spread across 1,983 employers in this rate code, to give us an average increase of $175 per employer. S23, a net increase of 13 cents would have been applied, translating into an increase in total premium of $373,000, divided among 778 employers in this sector, would have translated into additional premium on average of $479 per employer. These hypothetical increases that I've just shared with you, again, comparing the current rate as it exists under the existing model compared to what it would have been, is a one-time transition cost of moving from the old model to the new model. Once these enhancements or changes have been made to the model, all that will drive the changes in the premium rate will be the injury experience of that particular rate code. There will be no longer any influences of transitioning from old model to new model. So what are our next steps? So firstly, today's presentation, as with all of the other presentations that we've made to the other industry rate codes, is being audio taped and will be on our website, WCBSAS.com. So if some of your colleagues who wanted to either join us online or attend today and couldn't for various reasons, interested in seeing the slide deck and hearing the presentation, they could listen to this at their leisure. We will have time for questions here. We have well over almost 45 minutes left for questions. However, this is probably feeling a little overwhelming in terms of the information that we have shared with you here today, and you may need a little bit of soak time just to kind of digest this a little bit. So if a question occurs to you tomorrow or a week from now or what have you, certainly you can submit those questions to that email address that's on the screen, askwcb@wcbsas.com. We ask that you use that portal for any and all of your questions so that we can collect a central repository for all the questions and share those with all the participants so they can also hear and see the questions and answers that were provided. We are also looking for your feedback in terms of how we transition from existing model to new model. And we've created a spot on our website, wcbsask.com/feedback, that has a bit of a survey on it where we're asking for your input, your feedback in terms of how we might transition. It lays out a couple of options that you can just tick off the boxes. One being, just implement the whole thing right from the get-go. Give it all to us at once. As you can appreciate, while each of the S codes that we've shared with you today are seeing increases of varying levels to their overall premium rate, when we look at all 50 rate codes, there are other rate codes that are actually seeing their premium rate go down. Because we have to maintain our system revenue neutral, if we were to mitigate somehow the implementation of the transitional effects of moving from old to new, for those with increases, we would also have to apply the same thing to those who would be getting decreases in order to keep the same level of premium that we need in order to fund the claims costs. So an option that's up there, however, is that we phase this in over 2 years. which means we would take half of what we're forecasting in terms of increases here today that might be proxies for what you would see in 18. We'd give you half of those costs in 2018 and the other half in 2019, which means we'd have to take away half of the decrease that someone else might be getting someplace else in the 50 rate codes, and only give them half of that in 18 and half of that in 19. Also bear in mind, again, we don't know, so even if we truly, and we would love to be able to do that today, share with you what we think 18 is going to look like, we just can't in any reasonable way anticipate what 2018 rates are going to look like because we don't yet know what the 2018 experience is. But to the extent that 2018 experience is better than what we're seeing in 17, might actually mitigate some of the impacts of the increases as a result of transition. But we have no way of knowing that today. You'll also see on the survey, though, just a box that says Other, where we would gladly entertain any other ideas or suggestions you have on how we might proceed with the transition. As I said to you earlier, one of those options is not saying, well, I like the impact of the credibility enhancement, but I sure don't like the impact of the fatality enhancement. We have to take all of these 6 things together in order to preserve the overall integrity of the rate-making model and improve the reliability and predictability of future costs and premium rates for the employers of this province. Be remiss of me if I didn't put in a plug for Mission Zero. Of course, the easiest claim to manage is the one that never occurs. The least expensive one is the one that never ever happens. There's been significant progress made, as when I was talking about the predictability of costs. There's significant progress made with respect to the reduction in the number of injuries in this province, both at the time loss and total injury level. And I'm extremely pleased to report that in 2016, 88% of workplaces in Saskatchewan went injury-free. 0 injuries. Tremendous progress for which we are eternally grateful to the employers and workers of this province, because that's where the changes have been made, is in the workplace. Really nothing to do with us. We still have a long way to go. We thank you for your continued and ongoing commitment to the elimination of injuries in this province, and ask for your continued support and commitment to further driving our injury rates down and getting us closer and closer to Mission Zero. With that, I would open it up for any questions that you have. For those of you that are here with us here in Saskatoon, I would ask that you use one of the microphones on the floor. As I said, because we are recording this, so that others can benefit from the questions and answers that we may have today. Those of you online, of course, you can submit your questions online, and we'd get Kaylin to read those out to us should you have any of those questions. So, any questions, please? By the way, your 2018 premium rates will be released in the fall of 2017, so typically we would meet with industry, have our general educational sessions in October, where we announce our preliminary rates for 2018. So that would be the soonest that we would actually know what 18 looks like. Kaylin, anything online? Nothing? Well, hearing and seeing no questions, I truly want to thank you for joining us here this afternoon and taking an interest in really your compensation system. We look forward to receiving any questions that you might have through Ask WCB, and certainly look forward to your ideas and thoughts and feedback in terms of how we might transition from existing rate model to the enhanced model. I thank you all very much for being here again today, and wish you a very, very safe and healthy day. Thank you.